Hey there, Mike with Financeable here. Today I'm going to tackle the concept of accretion dilution, which is a common interview question topic, and you really need to have this pinned down to succeed in investment banking interviews in particular. I'm going to walk you through the core concept and help you understand it in plain English and simple terms. I'm going to walk through a sample problem and then help you understand the rule of thumb that you need to know to answer the most common version of this question in interviews so you can get the job. By the way, if you find these videos helpful, definitely hit the like button down below and subscribe. We have a lot more coming. Let's hop in here. So let's start at the start. When we say accretion dilution, what does that even mean? So in short, accretion dilution has to do with the direction of earnings. An accretive situation is a situation in which earnings per share are increasing, and a dilutive situation is where earnings per share are decreasing, plain and simple. And that's really the punchline to this, in a sense, in the beginning. But when we talk about accretion dilution in the context of investment banking in particular, we're usually talking about it in the context of M&A, where a company is being acquired. So more specifically, for interviews, accretion dilution deals with earnings per share going up or down relative to pre-deal earnings for the acquiring company. So the question is, if I run a company and I acquire another company, do my earnings go up as a result of the deal or down as a result of the deal? And that's really the core of accretion dilution. It's really just the direction of earnings for the company post-deal. As a quick side note, this is really a public company concept. So when we talk about earnings per share, that's what public companies release to the public and it's scrutinized. And so really the focal point here is public company earnings and again, the trajectory of those earnings post a deal. So now let's talk about what earnings per share is at a very basic level to kind of frame the topic here. So earnings per share very basically is just net income relative to my share count. And when we think about accretion dilution in particular and the impact on earnings per share, what we're really saying is, how does M&A impact the numerator and the denominator of this equation? And if the net effect is for earnings per share to go up, the deal is accretive, and if earnings per share go down, the deal is dilutive. To be a little bit more specific, when we talk about M&A impacts, what we're really talking about is the benefits and the cost associated with executing an M&A deal. So let's take a look at what those are at a very high level. On the benefits side, what we're talking about is, first and foremost, the earnings of the acquired company. So if we buy a business, we get that company's earnings, and then synergies, which are either cost savings or revenue increases that result from the companies being more valuable together than they were as separate businesses. On the cost side, we have a few costs that we need to look at. We have interest expense if we raise debt to fund the acquisition of the company. And we have foregone interest income if we use cash out of our bank account, out of the company bank account to acquire the business. So we lose the right to generate earned interest on that cash balance. So that's a cost as well. And then if we issue shares to acquire the business, that increases our share count, which reduces the value to each individual shareholder. So in short, we're looking at these benefits and costs. And the punchline here is, if the benefits outweigh the costs, the deal is accretive. And if the costs outweigh the benefits, the deal will be dilutive. Now that we've covered the high-level framing, let's look at one of the most common interview questions around accretion dilution. And the question goes something like this. A company has a PE ratio of 20 times and acquires another company with a PE ratio of 10 times in an all-stock deal, and that all-stock deal point is very important. We'll come back to that in a second. Is this deal accretive or dilutive? So that's what we're going to tackle today, is how you'd answer this type of question, which is one of the most common questions you'll get around accretion dilution in an investment banking interview. To illustrate this, we're going to look at a simple example here, and we're going to imagine we have one company that's acquiring another company. The acquiring company here is Gooey Cookie Co. And Gooey Cookie Co. has net income of $100 and 100 shares, so they have $1 of earnings per share. The stock trades at $20 per share, and as a result, their price to earnings ratio, or the price per dollar of earnings, is 20 times. Gooey Cookie is going to acquire Chocolate Cookie Co. Chocolate Cookie Co. has $200 of net income, 200 shares, and so also $1 of earnings per share, but their stock trades at $10 per share as opposed to the 20 for Gooey Co. And so their price to earnings ratio, or the price per dollar of earnings, is 10 times. So in this situation, Gooey Co. is the acquirer, Chocolate Cookie Co. is the target company, and we're going to look at how the acquirer would go about buying the target here. So the first question is, how much do we have to pay to buy out all the stock of Chocolate Cookie Co.? So Chocolate Cookie Co. has 200 shares, right? and their price per share is $10 per share. So what's the dollar value of the stock that we need to buy out this business? You've probably already guessed the answer. The answer is $2,000. So we need to pay $2,000 to buy out this company's stock, to own the company. And the thing is, we're going to pay for that stock with our shares as the acquirer. So Gooey Co. is going to issue new shares of Gooey Co. to buy Chocolate Cookie Co. to buy out that $2,000. And Gooey Co.'s shares are valued at $20 per share. So we have to buy out $2,000 worth of stock with $20 shares, because that's what we're issuing to buy it. And so we're going to need to issue 100 shares of the acquirer in order to get this deal done. Now let's look at what these two companies look like combined and see how that process works. So the first thing we're going to do, because this is an all-stock deal, is we're just going to combine the net incomes of the businesses, because their net income just combines. There's no debt or cash impact that we need to incorporate here. And what we're going to do then is wipe out, let me just wipe these out here. We're going to wipe out the target company shares, because what we're doing is we're issuing acquiring company shares to buy out the target company. And so as a result, the combined share count is going to be the 100 of Gooey Co.'s shares plus the new 100 shares that we had to issue to acquire the target here. The important thing to capture here is that before, let me just get rid of this, before we had 300 shares, but as a result of the deal, the share count actually shrank. That's an important thing to understand. So the acquirer here has a more valuable stock per dollar of earnings. So as a result, it has to issue fewer shares, and therefore the share count actually shrinks, but you have the same net income. So as you'd probably guess, the earnings per share from pre-deal to post-deal increase, and the deal is accretive. This is a critical point that's often missed when people first learn this, and that is that the direction of the share count in an all-stock deal is really what's driving this. So if I had less valuable shares to issue, I would have to issue more shares than the number of shares of the target, and the share count actually expands for the same net income, making the deal dilutive. And vice versa, if I have more valuable shares or more valuable currency is the term, the share count will actually shrink, and so I have the same net income but a smaller share count, so my earnings per share naturally go up. So that's really the underlying driver here. Just to hammer this home, on the next slide, I'm going to walk through a visual representation of what we just did, just to make this super, super clear. So in this next slide, I have basically the same exact example. I had to shrink the share count because it wouldn't fit on the page with 100 shares, but it's generally the same idea. So the acquirer has 10 shares. They have $1 of earnings per share and a $20 share price. So what I want you to do is visualize here the value per dollar of earnings for the business. You can think of it as value per share in this case, because it is just $1 of earnings per share, or just value per dollar of earnings. But either way, they have 10 shares that have a certain value. The target company has 20 shares and $1 of earnings, but trades at $10 per share, so they have more shares, but a lower value per dollar of earnings or per share. What that means is when the acquirer buys out all the stock of the target, they can buy out all 20 shares but issue half as many shares as currently exist, because they're issuing, remember, their own shares, and as a result, the share count combined shrinks, and we no longer have 20 shares over here, we have 10. So that's another way of looking at this, if this makes it easier just to see it kind of visually. But the punchline here is the acquirer shares are worth twice as much per dollar of earnings than the target. So as a result, they have to issue fewer shares to take out the target shares. And in this case, again, the deal would be accretive. So all of this leads to a rule of thumb that you can use to answer these questions, which we'll cover on the next slide. All right, almost done here. So the rule of thumb that you need to know for interview questions related to all stock accretion dilution is that if the acquirer's price to earnings ratio is higher than the target's price to earnings ratio, the deal is accretive. And if the flip is true, so if the acquirer's PE is lower than the target PE, the deal will be dilutive. And again, it's just because you're issuing with a more or less valuable currency. Now, the one key point I want to make here that's kind of a caveat is that with the examples that I just used, I used $1 of earnings per share for every example just to keep it simple. In real life, that's almost never going to be the case that a company has just $1 of earnings per share. The way that we normalize for that $1 of earnings per share is the price to earnings ratio, and that's actually why this rule is the rule. Basically, what this price to earnings ratio rule does is it normalizes per dollar of earnings. So hopefully, after watching this video, you have a much better sense for the concept of accretion dilution, the most common type of question, and the rule of thumb that applies to all stock deals. In a future video, we're going to cover the variations of this where we get into cash and debt and all the odds and ends that come along with that. So stay tuned for that. And if you like these videos, definitely hit the like button down below and subscribe. Hope to see you soon. Take care.